Welcome back again, guys. So today I'm going to be talking about on this video rather, I'm going to be talking about the market structure. So market structure is kind of like a pretty easy concept to grasp and understand. It's just that sometimes people want to make it sound somewhat complicated. I don't know, for whatever reason they see it fits to themselves. So my job is not to focus on other people. So let's just focus on what we are here to actually learn for today, which is just market structure. So yeah, I said market structure. There are two major types of market structure, and they are the bullish market structure and the bearish market structure. So just two type of market structure. We have the bullish and the bearish. So if you're not really new into trading, of course you should have one way or the other heard about the bullish market structure and the bearish market structure. Or to me, like as a technical analyst, there's no way that you wouldn't have heard about the bullish and the bearish market structure. So there's no need going too deep on sort of like explaining the bullish market. I'm just going to go into how I see it and how I identify them in the marketplace. That's what I'm going to be doing right here. So I then further said that market structure comprises of both a swing high and a swing low. Remember in the previous episode, which we talked about the swing points, I said swing points majorly forms the market structure. So now the market structure comprises both of a swing high and a swing low. Without a swing high and a swing low, there is no market structure. So for a market structure to be formed, we have to have both a swing high and a swing low. So then let's go then. So the types of market structure. So we have the bullish market structure. So I further said in the bullish market structure, swing highs are targeted, while swing lows are protected. So this is what I mean. So if you have a look at this image right here, as you can see, we have there's a high, there's a swing high, and there's a swing low. As you can see, this swing low was protected while the swing high was targeted. Targeted meaning that it was taken out by this push up here. And then once price pulls back in, for a market structure to be bullish, this swing low has to be protected. In other words, it doesn't have to be taken out, doesn't have to be violated. So price has to maintain the swing low. So as you can see, we had a pullback. This swing low was maintained, and this newly formed swing high that was created by the push downwards. Remember in the swing high, I said for a swing high to be formed, we have to have that curve, that swing point that has to push down. For me, I like a bearish candle. So once we have that pullback, so it forms a swing high. This swing low was protected, and then as you can see here, price ran higher by taking out the swing high. Then again, we had a push down again in the bullish market structure. This swing low has to be protected. So price push down, protects the swing low, and moves up and targets the swing high. So that's it for a bullish market structure. Coming. So then I further said, in other words, a bullish market structure builds in a higher high, higher low, higher to a higher high formation. So this is what I mean. So a bullish market structure forms or builds up in a higher low. Let's say, for example, this is a higher low, higher high, higher low, higher high, higher low, higher high, higher low, and then higher high. So a bullish market structure builds in this formation. It continues to maintain this formation of building a higher high, higher low formation. So it's just as simple as that. But now where it gets a little bit advanced is when we start moving into the time frame utilization and start adding concept like inducement liquidity and the likes. That's when it gets a little bit more advanced. But everything comes from market structure first. You must first understand what market structure is and how to identify market structure. So just as simple as that. So the next one on the list is a bearish market structure. So I said in the bearish market structure, swing lows are targeted while swing highs are protected. So if you go to this image over here, as you can see, this is a swing low, it's targeted. This swing high, or let's say this is a swing high, pushed up, and then this swing low was targeted or violated by this run lower. So then once we have a pullback, in the course of this pullback, a swing low is formed, and then this swing high, if we're in a bearish market condition, or in a bearish market phase, this swing high is meant to be protected. As you can see, we had a push up, and then we had a push down, violating the swing low. Then we had a push up again. The swing high has to be protected in a bearish market condition. We had a push high, and we had a run lower, which violates this swing low. So this is how a bearish market structure is being formed, whereby swing lows are targeted while swing highs are being protected. So that's how a bearish market condition forms. So then coming. So then I follow this setup in a bearish, in other words, a bearish market structure used in a lower high to lower low formation. And this is what I mean. As you can see, we have there's been a lower low, which I said is going to be targeted in the bearish market condition or bearish market structure. And we had a push up, which forms lower high. So lower high being protected. So lower low, lower high, lower low, lower high, or lower high, lower low. And then we have this lower low, lower high, lower low, lower high, lower low. So lower high, lower low, lower high, lower low, lower high, lower low. So this is how the formation of a bearish market structure goes. And yeah, so let's get into the Traderview chart to kind of like show you some examples of what I mean. So going to first look for a bullish market structure. See if we can get something close. Yeah. Now, so let's have a look at this as an example. So in the bullish market structure, I said there's a lower high and there's a higher high. There's a swing high. So we had a swing low. Then the swing high was targeted. And then when we have a pullback, the swing low has to be protected. So we had a push down. So the swing low is protected and the swing high is targeted. So this makes it a bullish market structure. Then we had a push down, which forms a new swing low here. So we had a push forming a swing high. So the swing low has to be protected. And then this uniform swing high will be targeted. And then here now we had a push down. Now there's a reason why price took out the swing low and maintained its bullish structure. This is where I was talking about inducements and also time frame utilization. The reason why this was not a shift in structure to move down was because of the time frame. Because this structure was built on another time frame. Not this was not M15 time frame structure. This was a structure probably on the 30 minutes. Yeah, this was a 30-minute structure. So we had a pullback on the 30 minutes time frame. So there was no need for price to had like this break of structure on the 15-minute time frame, which signifies a shift in market structure, which most traders will want to consider it being a bearish market structure. This was not a bearish market structure. This was a shift on structure on the 15-minute time frame to induce price to continue to go higher on the 30 minutes time frame. So in other words, this was a pullback on the 30 minutes time frame to continue is bullish market structure. So, but we'll get to that when we start talking about inducement and time frame utilization. So, with now, let's just stick to the topic of today, which is market structure, just market structure. There's no need going a little bit advanced or trying to make it complicated for now. So just start with a baby step, little step for now. So then we had a pullback again, as you can see, and then a continuation higher. So I said in the bullish market structure, swing highs will be targeted. Then this is a new form swing low. So we had a pullback. So in the bullish market structure, swing lows has to be protected. So the swing low was protected, and then we had a continuation higher, which means swing highs will be targeted. Then we had another pullback again, swing low protected, and swing highs targeted. So this is just a basic form of market structure. So let me move this to the right, so to an empty space so you can see it. So this makes it better. So you can see swing low protected, the swing high targeted. When we had a pullback, swing low protected, swing high targeted, pullback, swing low protected, swing high targeted. Then we had a pullback. I said this was a structure on higher time frame. This is why when we had a shift down, price continued maintaining this bullish movement. I said we'll get to that in the coming episode when we start talking about inducement, major inducement, and time frame utilization. So that's when we talk about this. So as you can see here, we continue the same bullish movement. We had a pullback, protecting the swing low, and continue making a new higher high. Swing high targeted, pullback, swing low protected, swing high targeted. So this is a basic form of a bullish market structure. So let's go down to a bearish market structure. So let me look for a market condition that forms bearish market structure in a way that I can use. Like I can see so many, but I'm looking for something that I can use as an example. So it will make a lot of sense. Looking for something clean and neat. So let me see the daily time frame. So that's yeah. So let's see. See. So the forwards permit me. I'm just looking for something clean. So I said I'm seeing a lot of examples. Or let's just go back to the 15 minutes. I'm seeing a lot of examples, but I just need something that I can use as something clean. I can use as a typical example for you all to kind of understand what I'm trying to talk about. I know this is not a concept that's new to some of you, but as you can see what I'm doing here, the main difference here is I'm able to actually give you defined stops. I'm able to define each and every stop I'm using right here. I'm not just picking it out and then using random stuff. No, I'm just telling you that there's a swing high without giving an explanation why that has to be a swing high and why that has to be a swing low. Or I'm not just speaking, oh, there's a bullish market without giving you a reason why this is a bullish market and why this is a bearish market. So this is where I feel there's a main difference between the market structure and the swing point I've been talking about. The main difference between mine and others is I'm giving you the precise and a well-defined theory, a more defined approach to actually identifying the stuffs in the marketplace. So that's the main difference between what I'm teaching you and every other stuff out there. So without wasting much time, let me just look for an example, and I think I found one. So this is like yes, this is a good example, but I wanted something better, but I couldn't find it. So but let's just use it anyways. So yeah, what I tell a swing low is there's a swing low. Why? We have a pullback, which forms a swing low by this bullish candle. So that forms a curve. If we go to the line charts, is this not a curve? Yep, that's a curve. That's a swing low, and then we have a curve down. That's a swing high. then the swing low, a swing high, then the confirmation lower. So, but let's get into the let's go back to the candlestick chart. So yeah, so a bearish market structure, swing highs. Let's start from here. So we have the breaker structure. So we have the pullback. So there's a swing high. So in the bearish market structure, swing highs are being protected. As you can see, the swing high was protected. So the swing high was protected. Then we had the pullback from the swing low. This swing low will be targeted. Then we had the pullback. Now this is an uniform swing high. So once we have a pullback, the swing high will be protected, and then this uniform swing low will be targeted. Then we had a new swing low by this pullback. The swing high now, because market structure is bearish for now, the swing high will be protected rather, that was a tongue twist. And this swing low will now be targeted. So if I move this to an empty space, so as you can see, swing high protected, swing low targeted, swing high protected, swing low targeted, swing high protected, swing low targeted, swing high protected, or the swing high protected, while the swing low targeted. So this is how a bearish market structure forms. So I think with this explanation of mine, it covers up everything you need to know about market structure, just basic market structure for now. When it gets a little bit more advanced, is when we start talking about applying the inducements and also majorly the time frame utilization, how to go between time frame and how to move between time frame. That's when it gets a little bit more advanced. Not too advanced, like advanced, not too advanced for me, but I think when I'm talking about stuff like this, it will be advanced to a lot of you because you all might be new to stuff like that. So that's that for this particular topic, which is market structure. So we're going to be moving to the next topic we're going to be moving into is liquidity and inducements. So liquidity and inducement, then we'll talk about the EOI, POI, and we're talking about the multi-time frame utilization. So moving into this new week, probably if time permits me, we should be done with three of this episode before the next week's begin, like before the end of this month, February, or no. If, first of March, I think is on Friday, so yeah, we should be done with this early next month, which should be between 2nd or 3rd of March. So I should be done with those three episodes. So I just want like I think the process is going to be fasting. So in the next 2 to 3 weeks, we should be done with everything. That's what I'm projecting. If there's nothing that comes up personally for me that will take me out off teaching and stuff. But with everything planned well, we should be done in the next 2 to 3 weeks. So that's that on this episode. I hope you find this episode insightful and helpful to your trading journey. And until when we get to the next episode, which is liquidity and inducement, stay safe and be blessed. Bye bye.